The more seasoned investors, or ones that they're obviously not going to live in the property at all, private lending, commercial lending, and conventional lending are going to be your three main sources of lending for the average investor.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And Icon Realty Group, helping home buyers, sellers, and investors in the West Michigan area. Find out more at theiconrealtygroup.com. Hello and welcome to episode 93. My guest today, James Eerdmans, has been in the real estate business for over 20 years. He's bought and sold hundreds of properties since purchasing his first 4-unit. James is also a licensed real estate broker and owner of American Realty Property Management. He's also the branch manager at the Grand Rapids branch of Finance of America Mortgage, and he's well versed in the different types of loans available to home buyers and investors. James, welcome to the show.
Thank you. Thanks for having me.
So I know you have this vast real estate investing background. I am looking forward to having that conversation with you. But today we're going to focus on financing. I guess my first question to you is just with all of your real estate experience, what is it that has made financing and providing these products to investors and home buyers so interesting to you?
Ironically, I got into lending as a result of being into real estate, and I got into real estate as a result of being in construction. Shortly after graduating high school, I had a small business, a service business that was a pressure washing and a painting company, actually. But it was seasonal. And at that time, I actually got my builder's license to receive contractor discounts on paint products and things that revolved around that business. And one of the things that I had wanted to do with some of my key employees to retain them over the winter months when we were kind of off season was to find things they could do during that time. And I was introduced to a guy that was a real estate broker. He was an investor, and he kind of took me under his wing, and along with some of the people he worked with, to get into remodeling and contracting of distressed housing in Grand Rapids, fixing them up, and then he would resell those and also keep some for rentals. And that really kind of intrigued me and was my first foray, so to speak, into real estate. And again, the internet wasn't too preeminent down in those days. And so to have access to data, you had to become a realtor. And so I kind of saw myself buying some rental properties and enjoyed the flipping. So before a lot of these HGTV shows were out there, I started getting my hands dirty on buying a foreclosure, fixing it up, and then reselling it. And then what came with that was, buyers would call me, and then I would be instrumental in referring them to either a realtor or a lender. Real estate wasn't such a big deal, but I really struggled in the lending side to find lenders that would do a good job. And it really is always tricky lending, and always has been, when you're dealing with a house that previously was foreclosed, has been remodeled, and now is selling for a larger dollar amount because there's been a lot of people in that industry that have mismanaged that, and straw buyers and or even fraud. I mean, people just really trying to take advantage of that, making a quick buck. And so there's a lot of flashlights from a lending perspective on transactions like that.
Are you saying that what the lenders were very concerned because a lot of the properties that they might be making loans on had gone through several different buyers who may not have taken care of the property the way they were supposed to, or overpaid for it, or not done the rehab work that they... Yeah, so let's just use some basic numbers. Let's say a house was lost to the bank for foreclosure, and an investor like myself purchased it for $100,000. And let's say that I put $30,000 into it and did a nice rehab, and then sold it for a profit at $150,000. When a buyer goes to buy that, part of that process, there's an appraisal. And when the appraisal's done, all of that data is conveyed, and the underwriter at that lender is going to see that. So they're able to say, okay, well, this house is now selling for $150,000, but yet 6 months ago it sold for $100,000. What
what happened between then and now.
What's the magic that brought
Right.
it up $50,000?
And you have some people that, again, were unscrupulous. They would put, you hear the term lipstick on a pig. They would put, maybe some new floor coverings and a little paint in there and raise the price by $40,000. And that probably wasn't real indicative of true value.
So banks got somewhat savvy to that and said, you know what, we really need to make sure that the value is truly there.
Right. Because historically, you would have a higher percentage of default on those kind of loans. And so they're gonna take a look at that and say, hey, we want to make sure we're not over lending on that collateral. That collateral is actually appropriate for the money that we're giving out. So again, they're challenging. And I learned going through this stuff, hey, let's document what we're doing. So when that appraiser does come through the property, I'm able to give him detailed information about these are all the improvements I've done since purchasing the property. Here's some before and after photographs to evidence it. It's a good idea to encourage those appraisers to really take good photos, really provide good narrative, because that underwriter and that lender who's approving that loan on the end doesn't have the luxury of walking through the home and probably even being familiar with the area to get a great comfort level with that appraisal. So the better that appraiser can do, and the more that appraiser can illustrate really the improvements, the more of a chance they're going to make a quality loan decision.
So as an investor, it really pays to document the improvements that you're putting into the property.
Absolutely.
Because you're going to need to justify them in order to get the appraisal to where you need it to be.
Yes. I get a lot of referrals from a lot of investors here in the Grand Rapids area, realtors that know that I've been obviously active in a lot of these fronts personally. So I'll definitely try to encourage anybody who I'm speaking with that early in the process. Look, do your best job. Give these appraisers something to hang their hat on to verify and validate the value that you want to sell this home to a buyer for. So, and because of that, I get a lot of clients that do a good job doing that, and then they're pretty instrumental with trying to ensure they recommend me for the loan, because I'm going to be able to go to bat and get those loans done. A lot of other lenders who don't have a high level of exposure with this type of lending, they may not really package that and do well, near as well, and deals can fall apart due to that.
So let's talk about what you do at Finance of America Mortgage.
Yeah, so we're based out of Philadelphia, and there's a couple branches locally, one in Granville and one in Grand Rapids. I manage the one in Grand Rapids. We do, all your standard lending. So your conventional loan products, your government loan products, which would be FHA, VA, rural development loans. We do that. We do have a nice commercial line of products that are available to investors. We can talk a little bit about that later.
Yeah, I'd like to talk about the different products.
And those are portfolio loan products. Our company is owned by the Blackstone Group, which is a large, private equity firm, and so there's a pretty good financial backing on that. And so we have a lot of diversity in the products we offer, and very competitive when it comes to terms, interest rates, closing costs. We have to compete every day against the local banks, credit unions, and other mortgage companies, and really probably our biggest competitive advantage is going to be in the operational aspect. I've got everything from the starting point to the finish is handled at our branch level, so we've got a lot of control over the overall process. So obviously starting with the origination, which would be me and my team, dealing with borrowers and going through and pulling credit and going through the origination process. And then through underwriting, I have an underwriter right in my branch who does a great job and understands a lot of the type of loans that we do, maybe more than other people. And then the closing department. So everything from A to Z is done there, whereas sometimes when you're dealing with a larger lending institution, it's more of a production environment. You're going to deal with a loan officer, might do a great job, then it goes over to another department. You might be handed off there, and you might go through 2 or 3 different things. Left hand doesn't always talk to the right. Delays can occur, and just not as smooth of a process.
And when you say larger lending institution, you're referring to like one of the larger banks?
Yeah, once you get to a certain size, it's just inevitable. It isn't necessarily a negative thing. It's just when you're dealing with hundreds of employees versus 15 or 20, you have to have protocols that are different. And so we're a little more nimble. We're a little faster moving, and that's a benefit to a lot of our clients.
Yeah, let's kind of talk about that, because I want to kind of bring this to the financing 101 level.
Sure.
Because I think a lot of people don't understand that there are a lot of different products out there and a lot of different types of lenders out there. When they think of getting a loan, they think of going to the bank and getting a loan.
Yep.
But you're not a bank. You're a private equity. You're backed by a private equity firm. So there's a difference there, because you've got your credit unions, your small local banks. You've got your larger institutions like, say, Wells Fargo or Bank of America. But you're a different type of lender. Like, what can you do that traditional bank lenders aren't able to do?
Well, first, let me just try to clarify maybe some of the differences. So there are a lot of similarities and there are a few differences. We are a lender, meaning we do have a lot of the same rules, regulations, and just overall dynamics that the credit unions and banks and et cetera have. For instance, if I'm underwriting a conventional mortgage, I have the same loan guidelines that another local bank is going to have. That isn't specific to Finance of America. If I'm doing an FHA loan, I have the same guidelines in theory that another bank would have. Now, there are some things called overlays, and what those are a little bit more additional restrictions. So like the government, HUD, generates all of the rules or the guidelines for FHA loans. There are other lending institutions that may view those as a little bit more liberal than their liking. So they may implement what's called an overlay. For instance, there is no minimum credit score required on an FHA loan. Finance of America has a minimum credit score of 580, which means that anyone below 580 would not be eligible for financing on an FHA loan with Finance of America. Many lending institutions would have a 600 minimum credit score or a 620 minimum credit score. Those are all overlays. And so I'd like to think that we probably have fewer overlays than most of our competition, which again was going to mean that there are going to be more people that will qualify for a loan with us than that will qualify for them with our competition.
So if you're a home buyer looking to get an FHA loan, you could go to a traditional bank, but they might have a higher credit score requirement.
Correct.
And they could come to you, and because yours might be just slightly lower, they could get financing from your company where they couldn't get financing somewhere else.
Correct. Some other differences would be, when you walk to your local community bank, you obviously are facilitating many different services. You can hold your checking account, your savings account there. You can get an auto loan there. You can get a boat loan. We only do real estate lending, so we're specializing in that. Another thing is servicing. So sometimes when you walk into a local bank, when they close a mortgage with you, you will always make your payment to them. With us, we service about half of the mortgages and we sell or transfer about half. Some people would view that as a negative, some don't. In theory, every single mortgage that anyone ever signs, the lender always reserves the right to sell or transfer that mortgage. Some lenders make a practice not to do that very often. Other lenders sell every loan that they close and don't service any of them. But the servicing really is a part that it doesn't matter where it's done. I mean, you can.
And when you say servicing, basically you mean every month when you pay your mortgage, who are you paying your mortgage to?
Correct. Now, once you close on your mortgage, it doesn't matter who is servicing it. If that loan gets sold or transferred, your terms remain the same. So there's never a change in terms when a mortgage is sold to a different servicer. But some people may prefer convenience of walking down to the corner and making their payment. Most people these days are going to set up an auto debit, pay online, and access their account online. So it doesn't matter if the Wells Fargo is your servicer, Citibank's your servicer, or the bank on the corner. And the ability to sell a mortgage really brings more players into the game and oftentimes results in being able to offer more competitive terms, because banks are like any other industry. There's going to be some that are more competitive than others, and you want to have so much, you want to be able to have the pick of the litter to say, hey, look, where am I going to get my most competitive terms? That's obviously a factor when someone decides to get a mortgage, is what are my terms and how low of an interest rate can I qualify for? And, what are my closing costs going to be?
by terms, that would be what's the interest rate going to be? What's the amortization going to be? What's the, is there a balloon payment or is it fully amortized? Those kinds of things.
So some of the what I would say are probably our competitive advantages compared to some of the larger banks and maybe some of the other lenders would be, let's just talk credit really quick. So many borrowers have blemishes on their credit. And not a lot of lending institutions are going to have a truly effective resource to be able to guide a borrower to not only just get qualified for a loan, but actually get better terms for a loan. So much of the criteria, probably the biggest criteria that dictates what interest rate someone can qualify for is going to be their credit score. So even though I might get a borrower or an applicant that I say, yes, I can get you a loan, but if your credit score was 20 points higher, I could get you an 1/8 or even 1/4% better interest rate. And so we're going to look at that situation and we're going to try in every case, whether it's a homeowner or an investor, and try to coach them into optimizing their credit situation to qualify for the best loans. A lot of lenders are not going to have that resource. They're not going to invest in that kind of overhead to do that.
So you might help them with a little bit of credit repair.
Yeah. So, and people that can't qualify for a loan, we've got programs for everyone that's really bad to just missing the mark. Mm-hmm. And people that do qualify, how do I get even better terms? And so we work with even third parties as well as things right within our own company to optimize people's credit and help them with repair. That's one thing. Again, the service, if we're talking to an investor demographic, from this show, we do a really good job with rental property investing. For reasons I talked earlier, it can be clunky. It can be a little more to it than just buying your own home. There's more dynamics when it comes to tenants and leases and putting more money down and those kinds of things. And just through experience, I've done so much of it over the years. I think we do a great job with it.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. I'd also like to tell you about Joshua Schaub and his team at Icon Realty Group, a full-service real estate company in the West Michigan area. Joshua has been a guest on this show several times, and he and his team at Icon Realty Group help buyers gain an edge in this competitive market. They assist sellers in getting the best price and terms for their properties, and they work with investors to understand the numbers, neighborhoods, and market forces that will set them up for long-term success. To learn more and get a free, no-obligation consultation, contact Joshua at 616-216-2000 or visit theiconrealtygroup.com. Yeah, well, I want to talk about different products that are available to different types of buyers. Like your typical traditional home buyer, what are some of the products that are available?
So first, we'll talk about just a regular, we'll call that owner-occupied home buyer. They're going to buy that home and they're going to live in it. You're going to have the most loan programs available for that occupancy type. So FHA loans, very, very popular as a first-time homebuyer loan program. The standard down payment for that is 3.5%. We actually have a product that will, it's a second mortgage product that will actually cover that 3.5%, essentially getting someone into a zero down loan program, which is pretty awesome. I don't know of any of our competition right now that has that.
So the second mortgage, basically, it's a second loan that they take out to cover the down payment.
Yeah, and there's two different forms of that someone could qualify for. They can actually qualify for a forgivable second, which means that it's free money they'll never pay back. There are some requirements for that.
They can't by the government?
No, that's actually sponsored by one of our investors in Idaho. And there are pros and cons to it. So to qualify for the free one, the free 3.5%, which is your down payment, you can't make more than 115% of the average median income. So if you make more than that, you do not qualify for the free second mortgage fund, and you have to make timely payments for 3 months. The downside is the interest rate is a little bit higher, but for those people that don't have the money, if you really do the math, they could be in this mortgage for the full 3 years. They would qualify to have that second mortgage forgiven, which essentially means it's free money. And then they could refinance or they could sell. And, the interest associated with that slightly higher interest rate will be less than the free money they have. So,
it's an interesting product. So essentially, if you're a first-time home buyer, you have the ability to basically get in for nothing down.
Yeah, and you don't even need to be a first-time home buyer. You just have to qualify for an FHA loan.
Okay.
So it's really it's a product that only goes over an FHA loan, and there's always closing costs and things like that associated with getting a mortgage. On an FHA loan, the seller can contribute up to 6%. So when factoring that, oftentimes people do truly get into a home for no money down on this program. There are other programs. MSHDA is another one that's popular in the state of Michigan, and that is a government bond program that requires 1% of the borrower's funds. It's a little bit more restrictive, but there can be some advantages to that loan program as well, which we offer.
And that's for home buyers.
Home buyers only, not investors.
MSHDA home buying loan for
FHA.
FHA.
MSHDA goes over top of an FHA loan as well, same as the other loan.
So it's still an FHA loan.
Yep.
But it's got MSHDA requirements which allow you to get in for less down.
And MSHDA will contribute up to $7,500 toward your down payment or toward your closing costs or both. But they do require the borrower always maintain 1% of their own money. So for a borrower that's got no money down, we have a loan program there on an FHA. For someone who does have a few dollars down, the 1% is an option for them. And for someone that has the full 3.5% down, then there's the normal FHA loan. And they can also get that as a gift. So they can get that from a family member, an eligible gift donor. It needs to be a family member. It needs to be an employer. It can't come from the seller or, the man down the street.
Wow. So there's a lot of different opportunities to get into your own home.
And then on a little bit less not quite as popular, but still great loan programs. Anyone who's who's a veteran who can qualify for a Veterans Administration loan, a VA loan, we offer those. Those are great loan products for those that qualify, as well as a rural development. So if you're in a target area, meaning kind of usually they're more suburban or rural areas, I should say, those are zero down loan programs. So, and they have some other advantages to them too. So if you qualify for a VA loan or a rural development loan, those are great homeowner options.
Is the VA loan a nothing down type loan as well?
Yep. They have a zero down program. So that's, it's really, really attractive with a good interest rate.
Wow. So there's some good products out there to help home buyers then.
Correct. Now investors don't have quite the, and then of course the other one is conventional. That's the most widely used.
Let's talk about conventional, just so we have it on the table there.
Conventional does have a 3% option. So as a home buyer that you're going to live in, meaning you're going to a homeowner who's going to live in their own home, can get into a loan for 3% down. Both Fannie Mae and Freddie Mac both have a program that home buyers can qualify for. Not everyone will.
And is conventional typically backed by Fannie Mae or Freddie Mac?
Always.
Is that the definition of a conventional loan?
Yes. Yep. And that's simply
both government agencies that basically
and Ginnie Mae. Yep.
And Ginnie Mae, which sort of back the loan.
Yes. What they do is they write the rules. We call them guidelines in our industry. And as long as a loan meets those rules, then they will obtain insurance from Fannie Mae or from Freddie Mac. So in the event of a default, the lender gets some relief from those agencies as long as they underwrote those loans and approved them based on the rules that Fannie Mae or Freddie Mac.
So conventional loans, what are some of the terms that you would see then?
So obviously your amortization terms are going to be your most popular, are going to be your 30-year and your 15-year mortgage. They do have 20-year loans and 10-year loans as well.
And that's fully amortized.
Fully amortized.
You're paying interest and principal every month, but within a 15-year or 30-year period, you've completely paid off the entire loan, and you would own your home free and clear.
Correct. Closing costs are going to be very similar for most of the loan programs across the board. Interest rates, typically actually the government loan programs, meaning the FHA, the VA, and the rural development, will have a little bit better interest rate, maybe like an eighth to as much as a quarter better than conventional. But conventional loan programs have some advantages. On an FHA loan, for instance, if you go with a 30-year FHA, you're going to have what's called an upfront mortgage insurance premium of 1.75% of the loan amount added to your principal balance. And with a conventional mortgage, you do not have that fee. You may have a monthly fee, and you're always going to have mortgage insurance if you don't put 20% down. So on a conventional mortgage, if you put 20% down, you have no mortgage insurance.
Your mortgage insurance can add how much to your monthly payment?
It depends. If you're only putting 5% down, it's significantly more than if you put 15% down. Mm-hmm. So, I mean, it can be, $50 to $400 a month, depending on the price of the home.
Just for mortgage insurance.
Yeah. I mean, if someone's only putting 5% down and they're doing a $400,000 mortgage, and again, some of this, the credit score and those things go into all of these rates as well. Mm-hmm. So it's really kind of a complete package. At the end of the day, hopefully the borrower comes to a good lender and they take an application, and then that lender is going to narrow down what are the best couple loan programs to consider and weigh out the pros and cons for each one.
So is that what you typically do, is you look at your borrower's credit score, their income, some of the other factors, and figure out which product is going to be best? If they're a veteran, you might look at the VA loan.
Correct. We're gonna recommend, if there's one clear candidate, we'll just emphasize, really recommend that one. But if there's a couple different ones, 2 or 3, then we'll lay them all side by side and illustrate the pros and cons, and then let the borrower decide what they feel like is in their best interest to proceed with.
Yeah. But I guess it's important for borrowers out there to understand it. They don't have to figure all this out themselves.
Correct.
Can you give me just a couple examples to kind of compare what a conventional loan today looks like versus some of the other, like an FHA, 1% down or 3% down or nothing down, as far as like interest rate and terms that you're going to see?
All the loan programs pretty much have the same options for clients to choose from. In other words, if they want a 30-year loan, if they want a 15-year loan, they can choose that if they qualify for them. As far as interest rates go, like I said, typically speaking, and again, this is generic, the FHA and the government loan programs will have a slightly more competitive interest rate, especially for clients that are not at the highest tier of borrowing. Now, what I say by highest tier, if you've got a 740 credit score or higher, that is you're going to be eligible for the absolute best terms with any loan program. If you are putting 20 or 25% down, again, you're going to be considered a very elite borrower, and you're going to be eligible for the best terms that a given loan program would offer. So, but there are so many different dynamics within that. You might have someone that has a lower credit score but putting a lot of money down. You might have someone with a higher credit score only putting a little minimum amount down. So it's really tough to compare, hey, this is what a conventional loan would be versus an FHA, because depending on the scenario, it could be completely different. But if we were comparing apples to apples and say someone was putting 10% down on an FHA loan and putting 10% down on a conventional mortgage, and they had a 660 credit score, I would say that loan program is going to be more competitive on the FHA front. If you have someone who's going to put 20% down with a 740 score, they would never look at an FHA loan because the conventional mortgage platform is far better for them. Mm-hmm. Okay. So it all depends on what the borrower's credit score is and how much that borrower is planning on putting down. And then to a smaller degree, even what their debt to income ratios are. Some loan programs have a little bit higher tolerance. I've seen FHA loans approve borrowers with up to a 57% debt to income ratio. And what that means is if you calculate how much monthly income a borrower has and you factor that against what their expenses are monthly, they're allowing up to 57% of their income to be offset by debt and still approving a loan. You would never get that tolerance on a conventional mortgage.
Wow.
Typically,
that seems a bit risky to allow for that.
There are those that would agree to that, and I'm not necessarily saying I would disagree, but I mean, it is what it is. Those are the rules we play by. So,
Okay.
but yeah. So again, there's so much that is determined on a case by case basis based on the borrower that it's hard to make generic.
Right. So you can't just say one is better than the other.
No,
really,
because
there's so many factors that go into it.
For sure.
Before we go on to products that are out there for investors, we've talked about on the show before the FHA 203K loan. Specifically, Kevin Murphy was on the show, and he had done a FHA 203K loan in order to house hack, where he bought a duplex, was able to roll in $25,000 in rehab costs. And then he lives in one side and collects the rent income from the other side, and is actually cash flow positive at the end of the month and his income is covering his mortgage. Can you talk about that loan product briefly?
Yeah, 203K loan is can be a really great loan program for certain situations and certain borrowers. Again, like every loan, there's pros and cons. They if you're looking for a home, and right now we're in a very, very competitive real estate environment, meaning, we don't have a lot of inventory. We're in an increasing market, meaning property values are continuing to increase. It can be really hard for buyers to find that perfect home. And they may actually have a home in a target area that they like, but the overall condition is less than stellar. In other words, it needs repair anywhere from 10 grand to, 100,000. I mean, you could, wherever your spectrum is. A 203K loan is an FHA loan product that provides for an ability for someone to hire a contractor, which HUD will approve, and go through normal protocols to do improvements on the property and factor those dollars in the actual loan. So someone buys a property for $100,000, wants to put $50,000 into it. They can qualify for that $50,000 repair budget
to be built into
their loan. Now, the caveats to that is that there's a few dollars more in closing costs naturally to offset the logistics of managing a loan like that. You do have to, your contractor has to go get approved and run things legitimately.
Yeah, you have to work with a contractor who understands the ins and outs.
You're not going to be able to do the work yourself. Mm-hmm. So it's like hiring a builder and doing that. But for the people that really find that perfect home in their area, but their only obstacle is the condition of it, this is a great loan program. Yeah. And so, but it is only for owner-occupied. It's not for investors.
Yeah, and we go into more detail in a previous episode. If you're listening and you're interested in that, Kevin Murphy was the guest, and I can't remember which episode that was.
Sure.
But let's talk about loan products for investors, because obviously you have all types of investors you're working with.
FHA is a great loan product because they only still require 3.5% down for a 2-unit. So for those individuals who like the idea of really keeping their housing costs down and, want to buy a 2-unit with the opportunity to rent the other side out to bring them rent income, FHA loans are great because they only require 3.5% down. But you do have to live in the one side. Conventional mortgages, when you buy a 2-unit, require 15% down. So a significantly higher amount of down payment for that. So that's an individual who's going to buy the home, live in one side, but yet from an investor mentality, rent the other side out. And again, you can offset, like the gentleman you referred to, you might offset it plus bring in positive cash flow. Maybe you offset half of your housing expense. Maybe you don't. It all depends on probably how high your purchase price is and how much your market rents are in that area.
And I've talked to other investors who they're not offsetting all their mortgage payments at the end of the month, but they're offsetting a good chunk of it.
Sure. And I will tell you, I am approached regularly by people with that goal. And I think it's an awesome goal because you keep your overhead down, your cost of living down, and especially if it's not your end-all home and it's maybe your first home or a transitional home for a handful of years. When you go to move out of that home, maybe you move out to a different school district, you get married, you have kids, and your life your life circumstances change, you can hold on to that property and say, hey, I want to keep it as a rental property, or you can sell it, whatever you want to do. But it's a great way to be a homeowner and still have a pretty affordable way to
rental income.
Yeah.
I mean, in my mind, and we've talked about it a number of times on the show, it's the best way for people who want to get into real estate investing to do so.
Yeah.
I mean, it makes so much sense.
You can get some very competitive lending terms because it's your primary residence, and you can get your feet wet with real estate investing and learn what that's about, dealing with tenants, dealing with collection of rent, dealing with maintenance and repair. And then that gives you a good foundation to see, is this for me? I mean, do I want to build a portfolio? Do I want to get more properties? How many properties do I want to get? So I think it's a great, especially people that start early. Now, if someone's in a different stage of life and they got a family with kids and a 2-unit's not going to cut it, then I get it. But if they're younger and they're looking to get into it, buying something they can live in one portion of it and rent the other part out is a fantastic idea.
Yeah.
For the other investors, the more seasoned investors or ones that they're obviously not going to live in the property at all, conventional mortgage finance and commercial lending are really, we'll say private lending, commercial lending, and conventional lending are going to be your three main sources of lending for the average investor.
Okay, so please define what each of those are then.
So conventional lending, we've talked a bunch about. That's going to be a Fannie Mae, a Freddie Mac conventional loan program. They write the rules. You will put 20% down if you buy it. No ifs, ands, or buts about it. But I believe those to be the best, most competitive loan products that you can get. So those, in my opinion, that should be the end goal. If you are holding a property long term, that is the best type of financing because your terms are fixed for the full 30 years or the full 15 years, whichever amortization schedule you plan. And I've been doing this for long enough where I've been in the high times, I've went through the credit crisis times, and I've dealt with all forms of lending. And I can tell you the conventional lending is by far the best for long-term holding.
Yeah, and that's as long as you're buying residential property, which
correct,
would be
1 to 4 units.
1 to 4 units.
Correct. Anything over 4 units is going to have to go commercial, or it's going to have to go private funding. So commercial financing is going to be where you go to either a local or, we have a commercial lending platform as well, but it's really the bank's own money. They are not, they write the rules. They're not having to subject themselves to a higher power, so to speak. And if they like the risk, they will do it. Some positives on that is someone that might have a very familiar, say, banking relationship with somebody. They may be able to convince that bank that this is a great risk, even though they may have a few bumps on their credit, or maybe there's something else about the transaction that is less than perfect. It's a little more relationship-oriented lending, but that lender is still going to look at that and say, is it a good risk for our bank? Probably the biggest downturn of commercial lending is that terms are usually only fixed for 5 years. The amortization schedule may be predicated on a 15 or a 20-year payment term, but they will only lock the cost of their funds or your terms for 5 years. At that point in time, you have to go back into the lending institution and you have to see where interest rates are at that point in time. They're going to look at you. They have the right to not renew that note and call it due, after which you've got to pay it off or finance it with another lender. Or they may end up renewing it and just charging a few $100 to do so. I've had both of those situations happen. The thing why I say that's a negative is that you don't have control over that for the life of your loan. When you get a conventional mortgage, once you get approved and close on that 30-year mortgage, you don't ever have to worry about that note being called due unless you make a late payment or you go into default.
Yeah, as long as you're paying what you're supposed to pay every month,
good.
You can keep paying for 30 years and
you got that security.
You'll never have a problem.
Correct. If economic climates change, commercial lending is going to change. For instance, when we went through the credit crisis, I dealt with a few local banks and, they had a lot of defaults in residential investment lending. They were under high pressure to not renew any of that type of lending as it as those loans from various borrowers matured. So even though I was a borrower that never missed a payment, never made a late payment ever, I had several notes called at the maturity of my 5-year notes.
And
being
these
due.
were commercial notes.
Commercial notes.
On 5 units or more.
Correct. And of course, it's all a relative market. The time that a commercial bank is going to call that note due and or not renew your note is going to be in probably a tough climate. Well, a tough climate's also going to be the hardest time for you to redirect that loan to another lender, or maybe even personally pay it off. So that was a very frustrating time that I had. I understand it economically. I mean, I get it. But from my point of view, if I have options, you need to be aware of that. And you need to be aware of cross-collateralization. It's another term. If you're doing more than one loan with a given commercial lender, there may be language in your loan documents that says when one loan matures, the bank would have a right to call all of the notes due at its discretion. I had that happen.
On commercial properties.
On commercial loans.
Oh, so that's scary because you might have one that's underperforming, but the others are doing fine. Well, now those are in jeopardy, huh? And
not even underperforming, but you might have, again, the culture, philosophies, direction of the bank may change. And it's like, let's say you've got 5 properties and one matures next year, and they're like, hey, look, we really don't have a desire to be in this kind of lending anymore, even if this borrower's been great. Okay, James, all your notes are due, or borrower A, all your notes are due. We're giving you 30 or 60 days to pay them off. Then it's a poker game. All right, well.
So how do you protect yourself against that? What are some of the solutions today for borrowers out there who are trying to get a commercial loan?
I can tell you what I do. I'm very, very I'm concerned with any cross collateralization. So anyone that's been through a loan knows that there's going to have to be a lot of trust placed with your loan officer because there are a litany of documents that you sign, and it's very, very improbable that a borrower is going to read every one of those documents, and including all the fine print. So I would say first, align yourself, if you're going to go with commercial lending, align yourself with a local bank or a loan officer or lender that you are very, very comfortable with that has a vested interest in your success. That I think is number one. Number two, I think you want to vocalize that you are not interested, unless it's impossible otherwise, to have any cross-collateralization language in your note. Every note should stand on its own 2 feet. Either lend me the money based on that collateral or don't lend me the money. So I would, at this point in time with all my loans, that's what I aim to accomplish. As far as your amortization terms, there are terms that are longer than 5 years. You could possibly get 7 years. Sometimes you may get 10 years. I would ask the loan officer if those options are available. They're usually going to come with a higher interest rate because the bank has to hedge what rates are going to be over that period of time. So you're going to pay a little bit higher rate, but on a case-by-case basis, every borrower should analyze their own risk and say, do I want the comfort of a fixed rate for a longer period of time at a little bit of a higher rate, or am I comfortable with a 5-year risk? So those are the kind of things that I would advise a borrower to do if they are going the commercial lending route.
Let's bring everyone up to date here. So we're talking about for investors, different types of products that are out there, and you talked about the conventional.
Yep.
We're talking about commercial, and we'll get to private in a moment. But I want to just hang on commercial here for a moment. You talked about the banks, going to the banks for commercial lending, but you're not a bank. You're a different type of lender.
Right.
What are the differences in the commercial products that you can offer?
We actually have, we've got a few products that, depending on the investor. So we have, if you're just a smaller time guy and you're doing a one-off, one here, one there, one at a time, we have a commercial loan product very similar to what you'd experience at a commercial lender. There are a few things like a minimum loan amount of $75,000. We're not going to tinker around in that $30,000, $40,000 loan range.
So you want to be lending at least
$75,000.
$75,000.
And we also have stuff for big portfolio investors. We have stuff that's $1 million, $3 million, $5 million loans. So Typically, it's residential real estate, someone buying a big package of properties, 15, 20 of them, someone either buying one. But again, all the things that I just articulated regarding that is going to be somewhat applicable to ours too. Flippers. There's a lot of people out there that kind of have got a little bit of a niche buying a property, fixing it up, and reselling it for a property called a property flip. And we have loan programs that will assist people in cash flow for that. So, yeah, but on the commercial lending front, there was a couple more points I wanted to make. As far as an advantage goes, when you're getting a commercial loan, there's a little bit more latitude on the appraisal process than there is on the conventional side of things. On the conventional side of things, our appraisers are required to validate the value of a property based on sold comparables. In other words, I'm going to look at this general neighborhood. I'm going to look within the last 12 months, and I'm going to look for similar properties, and I'm going to make sure that there's a history of sales that are going to support the value so that I can, finish my appraisal. Sometimes that can be hard, especially in our current climate where values are increasing, and every month it seems like there may be worth a little bit more, or this project or different areas of town are turning the corner, so to speak. On a commercial loan, commercial lenders have an ability to factor other components. They don't ignore the sales aspect of it, because that's always going to be an important aspect of an appraisal, is what other comparable sales in this area are there. But they can factor things like an income approach. They can say, hey, look, how much income is this property going to generate? And does that make a lot of sense for what we're going to look to lend this borrower? So there's different approaches that an appraiser takes when he does an appraisal. The sales approach, which is the comparables, the income approach, which takes a look at the income coming in compared to the debt being serviced, and then the cost approach, which is how much would it cost to build this thing from ground up. And so lending, or commercial lending, has a little more latitude to factor the other things and doesn't exclusively need to place so much emphasis on the sales approach, which conventional lending is very, very heavy on.
Yeah, I want to just go back to a couple of things you talked about. You talked about portfolio loans, and you talked about flippers. I want to make sure people understand what you mean by when you say portfolio loan. Like, could you define that for us?
Yeah,
please?
A portfolio loan is, I guess the simple definition is, it's our money. So if you come to Finance of America and we are going to give you a portfolio loan, which is what this commercial lending platform is.
You're not getting the money from the government, Fannie Mae, Freddie Mac.
Right. We are taking the stockholders. The capital raised by Finance of America is funding that loan. So we write the rules, we write the guidelines, and we underwrite by those. So, and the same would hold true for any lender. So if you walk into your bank on the corner and you may not fit in the box, and they say, well, we're going to give you a portfolio loan, that means they're giving you their money and they're taking the sole risk on the performance of that loan.
Okay. Which means you have a lot more leeway on what you might loan
Correct.
on.
Yep.
And this is a term that comes up often if an investor has a number of properties, single families. This is where I most often hear the term portfolio loan used, is they might have 20 single families that they own free and clear. Rather than go get a loan on all 20 of those properties, they could go to someone like you and get a portfolio loan on the entire group of them.
You could. Let me take this as an opportunity to clear one interesting thing that people in the audience might not know or for sure want to know. If your objective is to get the best lending, again, my opinion is conventional lending for long-term holding is by far the best. Fannie Mae allows for a borrower to have up to 10 financed properties. So they will give up to 10 mortgages to one individual borrower. Now that is inclusive of your home that you live in, any other second home, cottage, whatever you might have. But let's say, for the sake of discussion, a borrower has their own primary residence and a cottage on a lake. They've got 2 homes that they have mortgages on. They could obtain 8 more rental property loans. If that borrower is married, the wife, if she qualified, could obtain another 10 properties.
Oh, so a husband and wife could have up to 20 conventional
Mortgages. Like if I showed you my credit report, I've got a bunch of loans from back before that when they even had this. I mean, at one point I probably had 30 mortgages, and then it might be down to 20 now. But as I'm working with people and their planning and their strategy, I always ask, well, how long are you going to own these properties? I mean, if you're going to own them for 5 years or less, then, you could, doesn't matter if you go commercial, conventional, whatever. Maybe even private's an option. Private financing might even be an option for you. But if you're saying, I really view this as a long-term investment for me, I don't see myself selling anytime soon. I want to position myself for the best financing I can for long-term purposes, then that's what I'm going to coach them to do, is be able to say, okay, you got a wife, maybe the wife doesn't work. How can we get her income? The income from properties can help a lot of times offset the debt of properties. So if you've got a wife, in theory, that might not even have an employed job, but the cash flow from the properties themselves hold the mortgage debt, and she doesn't have any other debt in her name, no car payments, no credit cards, no student loans with any significant balance or monthly payment, you may find to your surprise that person could qualify for 10 residential mortgages based on that.
That would be the preferred way to go if you're able to do that.
If you're able to do that, yes. So just kind of because a lot of people will ask me, how many loans can I get? How many conventional loans do I get before I have to go into a portfolio loan product like what we're talking about, or commercial lending? Commercial lending, that is portfolio lending.
And I'm glad you brought up the limit that's out there, because when I started investing in 2001, the 10 was the limit. You could get up to 10 loans. And then, of course, the bubble happened in 2008, 2009.
It shrunk down to 4.
It shrunk down to 4. At what point did it go back up to 10?
A few years ago. As we were coming out of that downturn, again, our industry rolls with the punches like everybody else does. And there was undoubtedly across the country a lot of opportunity in real estate investing coming out of our downturn because of how low prices had gotten, and really how cannibalized the real estate market was, with the only real activity in a lot of markets being foreclosures. And so they would just go, and the only buyers of those foreclosures were cash buyers. And so, that didn't do real well for increasing property values. So there was a lot of opportunities, and Fannie Mae, as we were coming out and the economy was strengthening and the real estate environment was strengthening, they started opening them up, saying, we know there's going to be good borrowers that want to accumulate properties. So that loosened a few years ago. Yeah.
So, and you mentioned flippers and rehabbers. What products are out there for them?
Honestly, we didn't finish our conversation regarding private financing, but this would fit right in there.
Okay. Let's combine the two. So we talked about the traditional financing, the commercial financing, and now we're talking about the private.
So private, you can use your common sense to realize, hey, I'm going to go and talk to the rich uncle, right? And I'm going to cut him in on some profits, and I'm going to, use his money. The pros and cons are you deal with the guy giving you the money, and that's pretty much your only boss. And, you just make sure you pay him back plus his interest, and you're good to go. You don't have all the red tape of and maybe even all the closing costs associated with getting conventional financing or commercial financing. So the flexibility, the ability to maneuver quickly, if there's private investors that someone may have access to, or maybe they get a line of credit on their home, it gives them a little pot of money to work with, or wherever they may get private money from. That's a really popular thing, I think, for a couple different things. The flippers, because of the short-term nature of a flip, I think it's oftentimes a great way to go for that. I also think it's a great way to go for the model that I've done most of my career, which was buying a distressed property, fixing it up, and once it's fixed up, then put it in service, meaning it gets rented and I get an end loan on it. So a lot of times I would use private money because, you can write an offer for cash. So if you're in a negotiation battle against your competition, writing an offer in, if you come in with cash, which essentially you could do with private money, you're going to have a theoretical advantage over someone who's coming in with financing.
Yeah, which can take 60 days or more.
Yeah, especially on a property that's got distress, and that seller may wonder how inspections and what the lender requirements might be for that. So I think private financing can be great. It's really, in my opinion, short-term stuff. If you're a couple years or under, and again, depending on the terms that you may negotiate with the person providing you with those private funds, they can be awesome. Now, that doesn't preclude the fact that if you've got someone that's got a whole bunch of money, cash, sitting on the sidelines, and they're willing to lend it out for 5% long term, and they feel like, having with real estate as collateral is a good long term investment, there may be some isolated cases where private financing could make a lot of sense for a long term hold. But most people don't have access to those type of individuals that are going to have that mindset. Most of the time, private money is going to come with a higher expense. You're going to have to split profits with them or give them a pretty good chunk of money for the use of it, because it's going to be a little bit of a higher risk to that person. But there's a place for it. And I think that's where you want to utilize it.
So it can be easier to acquire as far as all the red tape and paperwork, but what might be more costly compared to the commercial or traditional or conventional financing.
Yep.
Do you have access to any sort of private money pipeline?
I have clients and I have partners and I have some of my own stuff that I do, but not from a general sense. Not if someone calls me off the street and says, hey, heard you on the podcast and I love the idea of trying to build a rental portfolio. Do you have something for me? The answer would be no, I really don't. Personally, for me, I haven't been as active buying real estate because of how high this market is. And so it's a challenging one to find value in my business model. And I've got a very strict, rigid model of what I have. And so to fit that, I've got to be able to find usually pretty distressed properties at a good price. And then I can make my numbers work. But so I haven't been as involved with my private connections as what maybe I would have been 5 years ago. If you have enough strength as a borrower, bank money is usually always the cheapest. And if you can qualify for it, if you can get a line of credit, if you can get a bank to buy into your business model and provide you with the funds to utilize for short term, and then, that's a lot of times a good way to go.
You've done a great job explaining all the different financing products that are out there. What type of person are you looking to call you? Who should call you about getting a loan?
The people that could benefit from my services the most would be investors who are starting out, or medium, I guess any investor who wants to position themselves for long-term holding and wants to know the best financing route for that. Flips and, short-term stuff. With what I do, I don't offer that kind of lending. I mean, I've given some of my thoughts on commercial lending, some of my thoughts on private lending. Those aren't services that I'm really in the market to provide. The conventional lending, obviously I am, because that's the business I'm in. So for the people that are out there that are saying, hey, I'm interested in getting real estate investing, I'm interested in holding properties for the foreseeable future in the long term, and I want to know how I can be eligible and best position myself to take advantage of those lending terms, that would be the client that I can service. Mm-hmm.
And you also work with home buyers as well.
Absolutely. Yeah. Yes. If we're talking that, I mean, again, 80% of my business is with home buyers buying new homes or, whatever, but I do have a big vein of volume in business that's investor related and,
So home buyers, buy and hold investors. That's
yep.
pretty much.
Yep. And I would say I could be a value to a flipper who wants to gain knowledge on how do I structure my flip so that the person buying my home is going to qualify for a mortgage without having me have appraisal issues. Mm-hmm. You know what I mean? So if there are realtors out there, if there's investors out there that are active real estate investors and they're buying and selling homes and they're active with working with buyers who are buying homes that have been renovated, I would be a great resource to be able to guide you into saying, okay, here's the pitfalls. Here's what you want to make sure your clients are doing and looking for. And, and providing them with a lending resource that is not going to get tripped up on a lot of things that a lot of banks might.
All right. Well, James, this has been a fascinating conversation. And I know there's more because we haven't even touched on your real estate investing and your American Realty property management. We'll do that next time.
Sure.
So I'm
happy to be back.
Yeah, I want to thank you for just taking the time to talk with us today. I know this is a conversation that we haven't had on this show about financing and the different products that are out there.
Great.
So thank you so much for having it with us.
Hey, you're welcome. Good to be here.
This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And Icon Realty Group, helping home buyers, sellers, and investors in the West Michigan area. Find out more at theiconrealtygroup.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.